are now on the second part of the Financially Speaking series. And with me today is none other than my favorite finance coach himself, Mr. Waithaka Gatumia, all the way from Centonomy. Karibu sana.
Thank you. You are too kind.
We appreciate it. The first thing that I would like to ask you in this second one is with regards to the financial requirements, or rather the financing preparations for financial institutions to give you money to invest in real estates. So how can one prepare themselves and get their documents get their documents put together for the purpose of being financed by a bank or any other financial institution?
It depends now on the type of real estate that you're discussing here. So if there is a property, it is already in place, okay? Let's say it's a piece of land or it is a building of some kind, it already exists, then that property often serves as a security for the loan.
Yes.
What does that mean?
Yeah.
That if you as the investor or the borrower is unable to repay that loan, the bank is able to know, okay, if this person doesn't pay, at least there's an asset in place that if they default, they'll be able to sell and recover their money because it already exists. Okay, so if it's already in existence, then banks generally, if they can see that you have a sufficient cash flow from wherever it is, they're probably more willing to lend towards that because there's an asset behind that they're able to protect themselves.
Yeah.
It becomes a bit more complicated when you have a property or a plan. So like, where developments are done off plan. So it does not yet exist. So it cannot in and of itself be the security that the bank can protect itself with. So what does the bank need to know? If they're going to lend you money, they have to do their due diligence to say, if this person, how will we get our money back if this person is unable to pay? So they'll have to find another form of collateral, or they're looking at your and saying, this person is able to service a loan at this level, and your pay slip forms essentially the security. Your job forms the security that they're leaning on and saying, if this person is more likely to continue to pay even for as long as that project is going to be running, because there's no actual asset behind it. So depending on which kind of real estate you want to get into, they will look at that issue of security, because that's their business. As banks, they want to make money from lending you that money.
For sure,
yes.
for sure.
So you as an investor have to think, do I have security? If I don't, what will the bank require from me? If you're purchasing elsewhere and you have some form of security, let's say you have another property, you can use that property as security in order to purchase another one. And the bank is able to say, okay, since you already have one in place, we're going to be able to support you in that.
You're going to be able to support you in that. How can I separate the glitz and the glitter of owning real estate investment in certain areas with the actual profitability or benefits that I can accrue?
So do some simple calculations. And I think this is the thing. One of the mistakes we make as investors is that we don't consult widely enough.
We don't consult.
In fact, barely consult, but then we don't also consult widely with experts in the field. You want to speak to a real estate, even an agent, because agents have a lot of data from their interactions with real estate that is available. Talk to agents in specific areas and just begin to talk to them about what's their experience, what is the turnaround time on sales, what is the occupancy rate in terms of tenancy. Just talk to a few people within the area that you're interested in. That's one. So consult. But secondly is also to understand what is the return you're looking for. Because when you say ROI, return on investment, which one are you looking for? On average, within the Nairobi region, you're going to get, not even just Nairobi, in East Africa, Kenya mostly, you're going to get about 5% return per year on rental properties.
Wow.
On average. It's slightly higher than that when you go to commercial. So residential is about 5% of the value of that property in rent annually.
Basically your cap rate annually.
So if you don't fully understand that, you might be shocked at the amount of rent that's same. Often the rent is unable, because of that rate, you're talking about a 5% of the value of the property, the rent is often not able to repay a loan, for example, that you borrowed for that property. It may be able to cover, because right now we're getting loans at 15% and above.
Yeah.
So if you come into the investment with the wrong mindset that you're thinking, maybe I'll buy this property and my tenant will pay me rent and that rent will repay my loan, you may be shocked. So come into it understanding that it's a 5% cash return in terms of rental on an annual basis on average within the East African region. Real estate, and one of the benefits of real estate is that you don't have one source of return. So there's a cash return which is called rent, but there's also capital gain. What is capital gain? That investment that you made, that property itself actually appreciates in value. Which is why over the next year, you'll come to your tenant and say, we are upping the rent. Why? Because the value of the property has also increased. So you have two rates of return. It's only that the direct impact while you own that property is at the rental rate, which is about 5%. But over time, even the property itself is increasing in value. So if you have that in mind, then you will probably have a better approach to the investment that you want. So when you said return on investment, ROI, which one are you looking for? Is it a cash benefit or is it a capital gains benefit? If you approach it from that perspective, I think you'll make a better decision around and have better expectations around your real estate.
So still on the conversation of calculating return on investments, I think one of the most important things to put into consideration are expenses. And when we talk about expenses, taxation is quite a conversation. So just enlighten us on probably some taxes that we need to be aware about.
My opinion is that tax is not a bad thing. I think if you're going to function within any society, there needs to be some pooled responsibility, and tax usually is that pooled responsibility, because I can't build a road by myself. We all pay towards building roads that allow us to do work. We all pay to have police who are supposed to protect us. We all pay to have all these amenities that are there. So tax in and of itself is not a bad thing. I just pray that the taxes are used well for the benefit of those who have paid them. Now, how to think about it is depending on who you are. If you're the buyer, the real issues that you need to think about are like withholding tax on the loan that you've probably taken, if you've taken any kind of financing, and then stamp duty specifically. Those are the big ones to consider.
Withholding and stamp duty.
So withholding if you took a loan.
If you took a loan,
So just think about that as a cost on the loan itself. So you have to think about it separately. And then also the stamp duty that you're going to pay when you're receiving that property. So those are the main ones that you want to consider. If you're the seller though, as of last year, we have the capital gains, which has now checked in, and it is 15% on the gain that you have made.
15% on the gain that you have made.
As of now, but things change rapidly.
As of now, for sure.
With all the changes in the tax bill, so as we know today. So what does that mean? If I purchased a property at 100,000 bob, okay, and I sell it to you at 150, so I have gained 50,000. So 15% of that. That's how to think about it. It's a bit more complex when you start thinking about like if you've built. So if I purchased a piece of land, then I built a house or some kind of mjengo on that property. I am allowed to deduct from the cost of the building that rate. So it reduces my capital gains tax because I have added value to that property, and I've actually put money into it. So there are certain allowable deductions that you can be able to make. Those are the main things to consider. However, yet again, as we always say at Centonomy, please engage professionals at the point at which you're doing that. So don't just take what we are saying here and say, now I know everything. No. Please do engage with professionals who will be able to take you through all the obligations and potential deductions, so you don't have to pay more than what is required of you. But those are the main ones to consider.
All right, so Mr. Waithaka, I just would like to give you this opportunity to give us your parting shot.
The best investment is the one that matches your goal. So whichever investment you're getting in, make sure you have a goal first, because that goal will inform which is the best investment to get you there, or the best form of that investment to get you to your goal.
We also have amazing investments at Chanza Lifestyle. These are investments that actually work for you. So please do pay us a visit, and also hop onto our website. It's right on our description below, and it's going to give you more information about what we do. So thank you so much, Mr. Waithaka. We appreciate you for coming.
My pleasure.
Thank you so much. I will see you on the next one.